Today we'll discuss financial statements. Financial statements are balance sheet. Now we call it as statement of financial position, statement of income, retained earning, comprehensive income, statement of cash flows, and for other than that we have other financial statement presentation. For example, you are outside in America, your company is operating in Philippines, but you are an American company, so how to handle the local accounting and then what kind of statements you have to produce, this is I will explain. And if you are adopting IFRS, International Financial Reporting, first time, so what would be the requirement? This is what we are going to discuss today. If you are already an accountant and you know that what is asset, liability, equity, so it will be just a refresher for you. But we have to today discuss that what are the financial statements, what are the terminologies in terms of US GAAP and IFRS. Maybe you work in a company where you don't have so much revaluations or currency up and downs, hedging, swapping, so you may not have seen the other comprehensive incomes that way, but so it may be a new knowledge for you, but it is not, then it is just a revision. So okay, what is balance sheet? We call it as all assets. In accounting we have 5 things. Like in alphabets, in any language we have so many, we have 5 things. 3 are here. Assets, this should be equal to liability plus equity. How it goes is whatever you have as a person, either it's your own money or either this is a borrowed money from your friend, from your any sources you have accumulated, but both if you add them it will be equal to your assets. So this should be always balanced. Now previously we do go for this logic, but currently all financial reporting is focusing to make accounting for layman, simple. That's why we are not using a horizontal balance sheet anymore. We are using a vertical style of reporting, which eliminates the apparent concept of, means a layman cannot see this is an equation on the back end, because we are making it more in a presentation style. So this is what we are focusing on. This is just an example. We have assets, currents, non-current, and we have liabilities, equity. This is one by one I will explain. Just for your revision, what are current assets which useful life is less than 1 year? You can convert them into cash as soon as possible. So concept of liquidity is involved. Operating cycle is the term that we use till the time we acquire until we get the money from the customer. The whole process will be called as operating cycle. Current assets generally include cash, receivable, inventory, and other kind of, if you are into investment company, then you have available for sale, held to maturity, and prepaid assets. Non-current assets are those which useful life is more than 1 year and economic benefit will keep flowing for a longer period of time. So we say investments and funds for more than 1 year. If you invest less than 1 year, this will be your current asset. If you invest more than 1 year, 2 year, 5 year, that will be your non-current assets. Property, plant and equipment also, that is a long term. It includes building, equipment, furniture, fixture. These are the standard assets. In every business we do see furniture, fixtures. Some, if you are into manufacturing, then you will have a property, plant and equipment. If you are not in manufacturing, then you will have a warehouse only. It may be owned by you or it can be rented. So as the nature of business will change, the name and asset type will also change. Yeah, other non-current assets are also bond issuing cost, machinery rearrangement, long-term prepayments, deferred tax assets, receivables. This is, it's not that way easily you can classify. You have to read the contracts. For example, if you are a bank, you are investing in futures, forward markets, you are swapping. So we have to see what is the nature of the contract. Term and the conditions will decide that are we going to classify as a current asset or a non-current assets. So some assets we are always need to be judgmental based on the contractual obligations. Current liabilities are obligations that you have to settle within 1 year. As a person, we use credit cards. These credit cards are our current obligation. We have 45 days to settle the amount. So as a company, we buy trade payable, we create trade payable when we buy the purchases or stocks, and then we have other payable. Earned revenue, we use term when we take the money in advance, suppose, and the services has not been yet rendered. For example, you are Gulf News, you are magazine, and you have an annual subscription. You are a fitness club, or you are a polo or golf club, you go 1 year subscription, you pay in advance. So it is a liability so far, and on monthly basis we'll see how much is being earned and how much remains still unearned income. Unearned income is your liability till you convert it into income slowly. We do have other obligations like short-term notes, payments required under sinking fund provision. Sinking fund, when we create a bond, so as per law we have to create a fund. This fund will create or keep some money, depending on which country you are into, as a cushion. So that will be also a current liability. Payment on the current portion of serial bond who pays you money as a return based on a series of payment. It can be monthly, quarterly, yearly, based on that. That's why they are called serial bonds. Amount expected to be required within a relatively short time to pay, non-obligation, right? This is all your current obligations. Current liabilities do not include, he mentioned, short-term obligation if an entity intends to refinance them. For example, you have used your credit card, right? It was an amount of 100,000. Now, as you use, it is your current liability, because credit card will not give you more time. 1 day, 45 days, 30 days, you have to settle the transaction. If you will, okay, then you will make a call to the bank. You will say, okay, can you make it in installment? Now 12 months, 24 months. If you decide 24 months, then we will classify it as non-current liability, right? So you have to be very sure about the liability when it arises, when it has to be settled. Based on that, we will classify it as a current or a non-current obligation. Entering into finance agreement, meeting all conditions done before the balance sheet date, a post balance sheet date but pre-balance issuance of the non-current obligation. So how it goes is, later we'll study, there are two type of events, subsequent events. One is which happened during the year, but we didn't do any accounting adjustments for them, right? One who happens after finishing the accounting year. For example, if year is closing 31st of December, so it happened 10th of January. So these are two type of events. One require, if event happened after the accounting year, then it require disclosures only, right? If it is happened during the year and we didn't do any adjustment, so it require proper accounting adjustments, mean a debit and credit. So this way we will decide that what is the scenario, how to build up this. Non-current liabilities are those not classifying as current. So anything does not meet the criteria of current liabilities. Sometime accounting says this way: if a lease is not a finance lease, then it will become a operating lease. It's a standard language of the tax. They don't say what is an operating lease. They do define finance lease. You know, if 1, 2, 3 will met, then it will be a finance lease. Otherwise, it will be a operating lease. So same way he defined current assets, but anything which is not current asset will be a non-current asset.